There we go. Thank y'all so much for your patience with me. All right, now I've got some fantastic people joining me this morning, so thank you so much. Anybody that has never joined me before, let me introduce myself. My name is Angie Dunn. I basically help you turn your dimes into dollars. I want to make sure that you become financially free. My number one goal is to make sure everybody has financial success. Nothing bothers me more than to see our retirees, our seniors that have been in the workforce and they retire and they simply don't have enough money to retire on, or they have a health concern, which then throws them back into the workforce. Now that's very concerning for me. Now, if you're doing it because you love what you do and you want to, you want to meet new people, then fantastic. But those of you that really are not doing it for that reason, that's the concern of mine. And we want to stop that. We want to stop that as much as we possibly can. All right. So we're going to keep on going here. Now, introduction. My name is Angie Dunn. I am on every social media, Facebook, Instagram, TikTok, YouTube. I have a podcast channel. If you are viewing me for the first time, go find me on some social media. I promise you, you're going to get two things. One, a little Southern sass, because a lot of my videos are very comical, but you're also going to get a lot of good financial information that you may need. And it's kind of a mixed bag because we do everything. We're full brokers in all 50 states, so it does not matter where anybody is viewing from. We can take care of you regardless. Okay. Now, I'm certainly not in this alone. I've got some wonderful people with me this morning. Introduction, Mr. Paul Coleman. Mr. Paul Coleman has been with me. Golly, I guess it has been 8 years. Paul, really? Oh my gosh. Wow. You can unmute. 8 years in the industry, and Paul really focuses on what do you do with those funds when you do retire, right? How do we continue to get our money to make us more money, because now we need to make distributions. Or maybe you're not out of the workforce yet, but you're thinking about it. It's within the next 5 years, right? You really don't want to take a chance of losing that money. So Paul is going to give you a real good breakdown on that. Thank you so much for being here this morning, Paul. I appreciate it.
Absolutely.
And then we have Mr. Mike Mazzoni. Oh my goodness, guys, we could not ask for a better gentleman to bring up the rear for this. We're going to be here about an hour. If you've got any questions, make sure you drop them in the chat box. But Mike has been in this industry for 25 plus years, and he talks about something that I don't think is talked about enough, and that is long-term care. I am sure all of you know someone that is either needed in-home care or they've needed to go into a nursing home. So, Mike, thank you so much for joining me this morning as well.
You're welcome. Thank you. It's good to see you again.
Yeah, it's a great, beautiful Saturday. Beautiful Saturday. Now, how many of you can remember MapQuest? MapQuest, right? And y'all could drop this in the chat box. Put a one in the chat box if you remember MapQuest. MapQuest was before we got GPS. MapQuest was before, obviously, we had all these fancy phones that we could just pull up directions on, right? So what do? We went to MapQuest, we put in, where we wanted to go, and we printed that sucker off. And why do we do that? Because it gave us directions step by step how to get somewhere. Well, that's exactly what we're going to do here today. We're going to give you step-by-step instructions on how you can achieve financial freedom. Now, you've got to remember, everybody viewing right now is at a different stage of life. Some of you may be just brand new into the workforce. Some of you may be, in the middle of the road, right? You're in your 40s or your 50s. You're thinking about retirement, but you're not there. And then you've got some that are already in retirement, or retirement is coming very soon. So we have opened it up to give you a blueprint. No matter where you're sitting today, you're going to make sure that you got something real good out of this. All right, now I got two different qualifications, guys. I'll be honest with you. Y'all are looking at a 1960s model single wide trailer. My number one qualification comes from the hard knock life, okay? Was not born into privileged. My mother and father were very, very hard workers. But the problem is when they get around to retirement, they really didn't have enough assets to really be able to retire comfortably. So as I got into this industry, my number one goal was to educate as many people that would listen to me on how you can achieve financial freedom. So my number one qualification is that qualification of hard nut life. How many of you watching right now have had that same qualification? How many watching right now, put a one in the chat box, have had the exact same thing happen? Like you maybe you don't have a degree, but you have worked hard and you've got experience behind your belt, okay? Good morning. I'm also a licensed broker in all 50 states, so it does not matter where you're viewing from. We can definitely help you. It's not going to cost you anything. Anytime you want to schedule a free appointment with us, just know that is a free consultation, okay? Because we want to give you that free roadmap. Now, number one, I don't care where you're at in your stage of life. Everybody needs to have an emergency fund. I don't care where you're at in life, okay? Young, old, middle age, it doesn't matter. You've got to have an emergency fund because we can't control life, right? We can't control what happens. We might get hurt, we might get injured, we might get sick. Our car might break down, the roof might fall off, the refrigerator breaks down. We all have life, we have life that happens, right? So what are we going to do when that happens? Well, we don't want to just fall apart and crumble. I want you to start working on having an emergency savings account, but I don't want you to put that money in the bank. No, not a dollar of it in the bank. Only money I want you to keep in your bank is the money that you're going to pay bills on. The money that you're going to write a check. You're going to pay your mortgage, your rent, your car payment. It doesn't matter. That's where I want that money to go. Any dollar outside paying your bills this month, I want you to get it somewhere where it's going to make some interest, right? Your bank is probably paying you about 0.5%. I promise you they're not paying you more than that. Go look at your statement. But what if you could make the upwards of 5% on that same money that you're saving in the bank, right? What if you can make a little extra money? What if your money continued to make you money, right? So let's just look at an example. I'll tell you right now, my personal account, I'm making 3.8. Now, I've got some people that are make upwards of 5%, but my particular high yield savings account is making 3.8. So example, if I had $5,000 in that account at the end of this year, I'm going to have $190 that I earned just in interest, just for leaving my money sit there as a thank you. We appreciate your business. Now, if I was getting 5%, well, good gracious, I just made $250 and I didn't do anything but put my money in a high yield savings account. Now, there's no risk. There is absolutely no loss in this. This is just a savings account, guys. Typically, they're online. I do not have any brand ambassador deals with anybody. I do not have any collaborations with anybody. Go Google it. What you're looking for is one that does not charge you any fees, does not have any minimum requirements, and will allow you to draw money out of those accounts as often as you wish. Okay, so basically you're making 3.8 or higher, and all you're doing is putting in a savings account. There's absolutely no risk at all in that. You're not going to have 3 to 6 months right away. I want you to take every paycheck. Every paycheck, I want you to put a little money into that account, whether it be $5, $10, $15. And eventually, I want you to have 3 to 6 months of your entire expenses for the month saved in that high yield savings account. All right, let's keep on going. Guys, if you're just now joining, if you don't mind, mute your microphone for just a minute for me, and we will open up any kind of conversation later on. But right now, I just want to be able to keep out the background noise. So anybody that has got your microphone on, please make sure you've silenced that. Okay, going to keep on going here. Guys, how many of you have seen the national debt clock? Let me show it to you if you haven't. The sucker, do you see right here where it says U.S. national debt? Do you see it doesn't stop moving? Do you see it's constantly climbing? Guys, Social Security's almost broke. Medicare is almost broke. We are almost $37 trillion in debt. If you've never seen it, go Google this, guys. Go Google this. This is the U.S. national debt clock, and it's constantly running. That $37 trillion, that's money we've already spent. We don't have any idea how we're going to pay it back, and we haven't figured out how we're going to pay the bills today, tomorrow, next week, next month, okay? So what do we think is going to happen with taxes? Well, in my personal opinion, they're going to increase. There's no way around it. I don't see how it's possible, right? So what are we going to do about that, right? We obviously can't control that $37 trillion in debt, but what we can control is how we save our money, okay? We can control how we grow our money. So let's talk about ways that you're going to grow your money. Everybody watching right now, if your company offers a 401k plan, okay? If your company offers a match for your 401k plan, I can't get our picture out the way. I'm trying to shove us out the way. Sorry, guys. If your company offers a 401k plan, fantastic. I'm hoping you're getting a match. If you're not getting a match, don't do it. You're wasting your time, and all you're doing is creating tax. But if your employer says, hey, I'll give you 2%, 3 or 4%, and all you've got to do is put your match in, well, guess what? Now you got double your money, right? It's a no-brainer. You want to do this because they're giving you free assets. But I have to tell you, Don't think that this is some grandiose thing that's going to magically make you millions and millions and millions. The average 401k plan makes 5 to 8% annually. Don't believe me? Go Google it. 5 to 8% annually. That's all you're making. That's what you're making, 5 to 8%. Now, how many of y'all saw at the very beginning where I showed you a high yield savings account could make the upwards of 5% with no risk, no volatility? You just got to learn how to get your money growing. Why do you want to do a 401k plan? Because it's free money and you want to diversify yourself. Now, just so you know, everything is affected in your 401k plan. How many of y'all put a 1 in the chat box right now saw money that was lost at the beginning of this year? How many lost money and started to panic a little bit because the market has been so unstable? Put a 1 in the chat box right now if that was you, if you even looked at it. Now, obviously, there is exactly. A lot of you need to understand that there is market volatility and loss inside your 401k that you can't control, and there are fees. There are fees that you have never seen because you almost need to be a Philadelphia lawyer to be able to look at your statement on your 401k. Not knocking it, but I want you to understand you will also have to pay tax on this money. This money is not tax-free. This is not a gift. No, they're deferring your taxes until you retire. Now, do you think you're going to pay a higher tax rate today? Or do you think you'll pay a higher tax rate in 10 or 20 years? Obviously, I personally think we're going to pay a higher tax rate in 10 to 20 years. Now, let me show you an example here, okay? Let's just pretend you got $1 million inside your 401k plan. They say you could do a safe 4% withdrawal. You safely can pull 4% out of this. That's going to leave you about $40,000 a year. But guess what? You got to pay Uncle Sam. So now he's going to take about $4,000 of that. And that's just hypothetically looking at today's tax rates. They can increase, and even if you're in the lowest tax bracket in the future, the lowest tax bracket could be anything they wanted it to be. It could be 20, 25, 30%. It could be anything, and you can't control it. Now, some of you also have state taxes. Some of you in states that do not. So Florida and Tennessee don't have state, right? But some of you do. So if you had to pay state taxes, now you're down to $34,000 a year, which, basically transitions to $2,800 a month. Do you feel like a millionaire on $2,800 a month? Do you feel like a millionaire? I don't. I don't feel like a millionaire with $2,800. Now, if I had that same $1 million saved in an infinite banking, if I had that same $1 million saved inside a LIRP, a life insurance retirement plan, do you realize that you would not have to pay a single dollar tax on that, and you could have upwards of $80,000 a year that was completely tax-free? Let me show you how. Tax-free vehicles. How many of you, show me a 1 in the chat box right now. How many of you in the chat box right now have got any tax-free vehicles? Okay? Tax-free. Are you growing your money tax-free in any kind of way? Because let me just tell you, I think the tax-free method is going to be your best bet for the future. And it does not matter what age you are right now. You can contribute as long as you don't make too much money. Now, let me just show you an example. One of the ways that we're going to grow tax-free assets, a lot of you have seen or heard of a LIRP, life insurance retirement plan. Some of you have heard about infinite banking. Some of you have heard about IULs or cash value life insurance. Guys, let me show you an example of this. Hypothetically, because remember, I don't know your age, okay? So I've got to show you an example somewhere. But let's just say you were 25 years old and you were going to retire at 65 years old. Do you realize if you put $125 a week, $500 a month into your cash value life insurance, I don't care what plan it is, whole life, IUL, LIRP, infinite banking, it doesn't matter. You put it in some form of cash value life insurance, you would be estimated to have $1.2 million in tax cash-free accumulation. Tax-free accumulation. And $1 million in death benefit, and that's at the age of 65. Okay, now what does that mean to you? That means you've got $1.2 million that you can pull out completely risk-free, completely tax-free, and at any age. You heard me right. You don't have to be 59 and a half to pull this money out. You can be any age if you need to pull that money out. Now, this money is completely tax-free not only to you, but your loved ones when you pass. Now, your 401k, it is not left to your loved ones tax-free. If you do not take care of your tax problem while you're living on your 401k, you are passing that tax burden to your loved ones when you pass, and now they've got to do it. Pro tip, infinite banking. At age 70, let's say hypothetically you retired at 65. At 70, you've had 5 years. This thing has had no money added to it. Do you realize that the money continues to compound and grow inside that infinite banking policy? So now your cash value is up to $1.5 million tax-free. And that death benefit has now gotten to 1.7. Everything compounds and grows inside of this, guys. Every single thing compounds and grows. Now, what's another way you can grow your money tax-free? There's only two. We're only got two ways that we can grow this money tax-free. The second way is with a Roth IRA. Now, I think everybody should have a Roth IRA, okay? A Roth IRA, it is the one and only retirement account. So remember, you can't touch till you're 59 and a half. That will allow you to grow your money completely tax-free. And this also is passed to your heirs completely tax-free. Now, there are some restrictions. The IRS says, hey, if you make too much money, guess what? You can't contribute to this. So, basically what they're looking at, and they do change this from year to year. If you're single, okay, single, not married, you cannot make more than $150,000 per year. If you're married, filing jointly, you can't make more than $236,000. Okay. Now, there's also a restriction on how much money you can put in it. Remember, the IRS is not excited to give us anything tax-free. But if you had a Roth IRA and you were under the age of 70, excuse me, good gracious, I don't even know where that come from. If you're under the age of 50, you can put $7,000 a year into that account. Now, you can put in less. You just can't put in any more, okay? Now, if you're older than 50, they let you do a makeup payment. They're like, oh, we'll let you catch up a little bit on your retirement plan. So they will let you go up to $8,000 a year. Now, you can put in less, but you can't put in any more, okay? Now, this does go completely tax-free. Now, let me show you an example of that Roth IRA. This is my beautiful mother and one of my grandchildren, by the way. My mother is not, well, she might be watching me live, who knows, but happy Mother's Day, Mama, and definitely happy Mother's Day to everybody that's watching right now. My mother is very near and dear to my heart. That's why she's even in this example. But let's just say that 25-year-old retiring at 65, put in $500 a month. I basically wanted to keep the example the exact same on the infinite banking and the Roth IRA, just so you could see the difference. This can be broken down into weekly, so $125 a week. But look at this. You would have an estimated $1.3 million at the age age of 65. That's completely tax-free. So now you've got two vehicles that's growing tax-free assets. Can I ask you right now, everybody watching, I don't care if you're watching live or if you're actually in my seminar, how many of you have actually looked at your paycheck stub? How many of you actually looked at how much money you paid in taxes for the entire year when you filed your taxes? How many of you have to pay personal property taxes? How many of you go to the grocery store or the pharmacy or Target or Sam's Club and you buy things and you're like, oh, wow, that was a lot of money in taxes? Well, we can prevent that. You just got to allow us to educate you on how you can grow tax-free assets. Okay, you do not have to have every dollar that you got in a taxable vehicle, and you really should learn to be diversified if you want to know the truth. Now, I am definitely not going to pass this book over to Paul. Paul's going to fill us up without talking about a little bit of life insurance. Now, we talked about cash value life insurance, right? Cash value life insurance, if we go back here, when we were talking about the infinite banking, okay, we were talking about how this money is going to completely grow for you tax-free. This is permanent life insurance policy that you will have the rest of your life. Typically, people only put money in it about 15 to 20 years before the life insurance is paid off, which means you'll never have to put another dollar in it, and you have permanent life insurance coverage that continues to increase every single year. But then I got a lot of people that want to know about term. So let's talk about why term would even be important. Well, term, you're renting your coverage. And because you're paying rent, you're paying less in premium. So you can get a bigger house, so to speak, and pay less money because you're never going to own it. Okay? It's not ever going to be yours. They're not ever going to give you the option to buy it. You're going to rent it for 10, 20, 30 years. And at the end of that time, you have no money and you have no coverage. And now if your health has declined, you may not even qualify for coverage. So why would people do term? Well, one, it's inexpensive, right? You can get a big policy for very little. Like me, I have a $500,000 policy. Very inexpensive, okay? But it is going to expire inside that 30 years, and I'm not going to have the money that I put in it, and I'm not going to have the coverage. And I can already tell you, my health is not going to allow me to qualify. Okay, so I'm done, whatever life insurance I have. So thank goodness I got some permanent life insurance. Most of you do not know, but I have non-alcoholic cirrhosis of the liver, so I'll never qualify, even though I look very healthy, right? I'll never qualify for life insurance ever again. Now, why else would you do this? If you purchased a home, you definitely should have a term policy, okay? Because you just made the largest purchase of your life. You owe $200,000, $300,000, $400,000, right? And if something were to happen to you in your lifetime before it was paid off, you definitely don't want to leave your significant other struggling trying to figure out how they're going to pay for that home. So if you had a term policy, you could do it for the same amount of years as you financed your home. The home would be completely paid off. Now the whole life, IUL, infinite banking, BYOB, it has so many names. Guys, you're buying permanent coverage that will stay with you for the rest of your life. The policy grows cash value. You can take that cash value out of that policy at any time for any reason. You're not penalized and you're not taxed. Okay. But you're also leaving this to your loved ones when you pass, completely tax free. So I know that was a lot of information in a very short amount of time. But guys, I even run over, even though I was talking 90 to nothing, baby, I still run over. But I want this to be the most educational hour that you've ever had. And I want you to understand, anybody watching right now or live, okay? Even if you're watching live, if you want more information on anything we went over, by all means, please reach out to us and let us know, because we're going to do that free consultation completely free. Now, Paul, I'll have to take a sip of water, buddy. I'm going to get you off of mute, and I'm going to pass the buck to you because obviously I'm going to stop my share. And you let me know when you pick up the screen. I want to make sure that y'all understand that Mr. Paul Coleman, he's going to help you understand how you're going to save those assets once you prepare for retirement. Or he's going to help you save those assets. Maybe if you change jobs throughout the way, right? We've got so many people that change jobs and you leave that old 401k plan out there and you don't know what to do with it, right? You didn't know what to do with it, so you just left it. We don't want to leave it. We're going to show you how to grow it. Paul, do you got control over that over there?
I do. So good morning, everybody. And Angie, thanks for all that great information this morning. And so guys, we're going to talk about, your 401ks, your employer-sponsored retirement savings plans. And the thing we want to share with you is really how to handle the risk associated with these accounts and how to work with bringing risk management to this important asset that we have available to us if we have 401ks, and how we help our clients protect that money so it's there for them when they retire. And so Angie and I do a lot of work with our clients to mitigate losses to these accounts. And with the way the market is right now, gosh, we get whiplash looking at how the Dow goes up and down, 500 points one way or another just about every other day. And so those are real losses that are impacting these retirement savings accounts. So we're going to use the term 401k here because that's what most of us are familiar with. But you may have a 403b. Maybe you work for a school system or a hospital or a university. Maybe you work for federal government. You have a 457. They're all sort of operate the same way. It's an employer-sponsored account. So I'm going to pull up some slides here and share with you how we help our clients manage that risk over time to help avoid these losses. But I want to go back and kind of discuss, before we do that, really what the phases of financial planning look like and how it changes through our working lifetime. So bear with me as I pull that up. I had a little bit of technical difficulty here this morning, so hang in here with me. I'm going to pull
It's
this up.
there. We're going to forgive you, Paul. We ain't even worried about it. You get us up there.
All right, can you see it, Angie? Is it there?
I can. Looks great.
Okay.
Yes.
All right, guys, here we go. We're going to express the timeline here that we work within. We call this the financial life cycle, and there are three distinct phases to this. It's the accumulation phase is phase one, then we go into the preservation period, and then distribution. We want to talk about each one here real quick. The accumulation phase basically starts when you begin your full-time work. I have age 20 here. It might be 16 for some people, 18, 20, around 20 years old is when we get our introduction to these employer-sponsored plans normally. So in the early stage, you can afford more risk to your plan because you're young, time's on your side, you have less money in the game, you can afford the losses, you have time to make it up. But as you move through this first phase, this important phase, it's important to begin to scale back on the risk. We're going to talk to you about how to do that in just a few minutes. But as you move through this horizontally on this timeline, by around age 50, we reach what we call the preservation phase. That's when we want to begin to really scale back on that risk to our accounts because you don't have as long to work. If you see here, visually, the yellow period is much shorter than the green. So time is not on your side. You don't have time to really recover if you suffer a catastrophic loss along the way. And this period from around 60 to 65 or 60 until you retire is what we refer to as the danger zone because you're critically short on time and catastrophic losses mean you're basically going to run out of money in retirement. And that's one of the biggest fears most Americans face today is we don't have enough saved for retirement. And what happens if we suffer this catastrophic loss late in our career? It spells doom for these 401ks. We're going to show you how we help our clients prevent that. Then we reach the third phase, which is what we refer to as distribution. This is when you want to be able to retire. We refer to it as permanent unemployment by choice. We don't want to have to go back to work. This is a period where we want to take all risk off the table to our retirement assets. We're not going to gamble with them. We're not going to roll the dice and hope for a big return. This is where you want to protect this money, and we're going to show you how we bring protection to that for our clients. So if you will, let me scale down here. We're going to throw some a vertical axis on this. We've got time on the horizontal axis. We're going to add money on a vertical axis here now and throw some curves in here and show you how we help our clients manage this risk. So as we talked about before, when you start in your 20s and 30s, you have less money in the game, but over time, this is the typical growth curve that we see. This is, when you get up to age 60, around this time, this is where you've accumulated more than ever, but you're not going to keep it if you're constantly in risk investments. You're going to face more losses. So as time goes on, you need to lower your risk as you're moving through this accumulation period. When you move into around age 50, the preservation stage, you want to have your money invested in more stable investments. You always want to be diversified, but you're not taking the most risky investment options available in your plan. You're going with a higher percentage of fixed assets. You're going to do whatever it takes to protect your money. And as you move through this preservation stage, you're constantly lowering your risk until you reach retirement. And at that point, you want all risk off the table. So you're not gambling with your retirement assets and gambling with your future income. Now, this is what we refer to as managed risk for these 401ks, 403bs, whatever the case may be. Now, let me show you what an example looks like for people who don't manage these. And again, you're not going to get this kind of education from your human resources people typically because it's not their job to do that. Their job is to bring you a plan. That's what their requirement is of the company that you may work for. They don't understand this oftentimes, and they suffer the same losses you do when we have catastrophic things that happen in the market. So, we're offering this training, we're offering this type of help to our clients to help you avoid these major losses, particularly late in your career. So let's take a look at what unmanaged risk looks like. So down below, if we don't lower this risk over time and we get to the latter part of our working careers here, all of a sudden we have a major loss. A couple of clear examples of when this happened during COVID, when 19 years worth of growth was wiped out in about 8 days. So, people lost trillions of dollars when COVID hit, and trillions of dollars with a T, by the way. And these retirement accounts were cut drastically for a lot of people. And, prior to that, we had the meltdown of the subprime mortgage industry in 2008. That's another clear example of when these retirement accounts took massive hits. And so when you take a big hit to your account at age 60, you just don't have the time to make this up. You heard Angie say earlier, a lot of these 401ks, the average returns on these accounts are between 5 and 8%. So if you're only earning 5 or 8% and you lose half of it at this stage of the game, you just don't have enough years to work to make it back up. So in this example here, you have someone who did not manage their risk. They kept their risk level very high, lost half their money. They made a little bit back. They lost a little bit more. And then all of a sudden they do retire and they start to lower their risk, but they're burning down their asset because they're drawing income. And look what happens. Around age 75, they run out of money. This happens every single day, folks, and it's so avoidable. We have the tools in place. We have the expertise to help you with this and to help you put a floor under your money. So as you go through the accumulation and preservation stage, we can help you prevent these losses going forward. So when you reach 75, you're not running out of money. Now, how many times do you go to, say, Walmart on a Saturday morning and you see someone 75 or 80 who is wiping down the carts? They have on their blue vest and they say, "Welcome to Walmart." Now, this is not a slight on Walmart or the people that are working there, but it's an example of why, so many people have to go back to work after they've been retired for a number of years because they simply run out of money. We
Well,
want to help
I'm,
you
I'm gonna
prevent that.
slow down. I'm gonna slow you down right there. I
Yeah,
want everybody to understand that Social Security is the only thing that you go rely on if you lose your retirement assets. And
yes,
the average Social Security check is about $1,300 a month. Poverty. You cannot live on just Social Security. So I need them to understand this is a way to protect your assets. If you've got those 401k plans from your employer and you're getting around to obviously preparing for retirement, I don't care if you're still working or not. If you're 59 years old or older, still in the workforce, doesn't matter. You can actually protect your assets. You can do this very thing right now. You could bubble wrap your money and not have to worry or stress if the stock market took a dive tomorrow. Sorry, Paul.
no, that's great.
Go.
That's exactly where we were going with this. So thanks for teeing that up, Angie, because at 59 and a half, you have the ability to move money out of this. You can't do it before that. You have to pay a penalty. But after age 59 and a half, and again, 60 is the danger zone. So we have the ability to help you move that money to a special type of IRA that allows you to place that floor under your money. So when those markets go south, and they do all the time, you don't lose a dime of your money. When markets move up, you move up with the market, you lock in at a higher level. You never have to face losses on that money again. And so you can continue to work as long as you want to. You can still be in the game. You can still get that important company match if you're getting one. You're still part of that plan. You're just simply moving your chips off the table. We refer to it as an off ramp, just like you may be driving on the interstate and you take an off ramp to go get lunch or whatever the case may be, or get gas or stop for a break. It's an off ramp for your money. You're able to put that money in a secure IRA that allows you to put a floor in that money so you can't lose it going forward. So it's a great analogy to consider when it comes to your retirement funding. So we're going to show you what that looks like over time and how our clients today are not suffering these losses. So bear with me as we go to the last slide here for my section here.
Paul, I'll be honest with you. I'll tell you a case that I did for a gentleman. He was in his 40s. He only had about $8,000 in an old 401k plan. Okay.
Mhm.
And of course, he's going to work another 20 years because he was in his 40s. Do you know that by just moving that money into this protected account right here, this fixed account that's guaranteeing growth, guaranteeing no loss, guaranteed no risk, do you know that 8,000 is going to turn into $57,000 by the time he retires?
That's
And
great.
he added no money to it.
Right.
He didn't
Right.
add a dollar to that thing. He just took all the risk and volatility off of it.
Exactly. And he never has to worry about any loss to that money over time.
Nope.
So this is a simulation I want to share with everybody this morning because it shows you how money behaves. And if we put these important retirement funds into what Angie and I call protected compound interest accounts, IRAs that allow you to retain your tax benefits over time, you're not paying any penalties because you're not withdrawing the money. You're simply moving it over. You're rolling it over. So what we do is in the green here. It's an indexed account. What you typically face with your 401ks or other retirement accounts, that money's invested directly in the market. That's the red graph here. The blue graph is a simple 3% 20-year plan. If you put $100,000 in this thing and in 20 years at 3%, it's going to spit out $175,000. That's not what we're talking about. This has its uses in retirement planning, but It's on here just to simply show you what 3% growth looks like every year fixed. So normally most of us are participating in our plans. We're facing the red graph here. We have ups and downs. So this is a 20-year simulation going back to 1998. And the first 2 years of this, the markets were great at the time. So this is $100,000 three times. One is in the green account, which is an indexed account. This is protected compound interest. The second one is in the market, in this case, the S&P 500. And the third is $100,000 in the fixed rate account. So over time, the first 2 years, you saw significant growth. But in the year 2000, what happened? We had the bursting of the dot-com bubble. We had a recession that came along. We had Y2K, had these things going on, and we saw significant losses in the market. But our clients didn't lose any money because we had a floor under that money. So when markets went down, they didn't lose anything.
Now, how many of you viewing right now were living and remember the Y2K? Do we remember how they thought everything was going to shut down? Like the whole world was going to come to the end when that happened.
Yeah, right.
But my point is, if you were working during the Y2K, you likely have assets that need to be protected.
Yeah, absolutely. So if you see here in the year 2002, this thing bottomed out and began to make the long climb out of the hole. So again, I'm referring back to what Angie said earlier. These accounts typically make 5 to 8% a year. So it takes years, as you can see here in this example, to work your way out of this hole. So the people in red here, by 2007, they were just getting back above where they were when the bottom fell out. But what happened again? The year 2007 comes along. We had the meltdown of the subprime mortgage industry, the derivative debacle. The whole world went into a major financial crisis. And so we had another 2 years of down markets. And during this time, trillions of dollars were wiped out of these retirement savings accounts. But again, our clients had a floor under that money, so they didn't lose a dime. They continue to move up in the up years. They lock in from year to year with no downside risk to their 401ks or to that important retirement asset. So this is one of the key ways that we work with our clients to bring safety to your money so that it is there for you when you're ready to retire and you're not gambling in it in a Wall Street casino. And that's typically what happens. And we see it so often when people are about to retire and some major catastrophic event happens in the market and half of their money can be gone literally overnight. That's how quickly it can happen. So I hope this was helpful. I hope that it brings some level of understanding to the real risk you face if you're 59 and a half or older and you still have these accounts in place. You're literally walking a tightrope without a net when it comes to your assets because there's no protection on there. This money is in the market if you still have it in your 401k, but it's important to understand you do have an off-ramp available to you for your money. You can move it into an IRA outside of your company plan and still remain in the plan and still get your contributions going in with every paycheck, and you still get your company match if you have one. And for those of you who don't have 401ks, don't have something available from your employer, we can help you create these types of plans from scratch on your own. And you mentioned it with the Roth IRA and the life insurance retirement plan. It operates the exact same way. So you still get the benefit of this indexing. You still have the benefit of the floor under your money. You lock in from year to year, and that money is available to you when you need it for retirement. So Angie, that's all I've got for today.
No, I'm gonna jump in there on the tail end of this because guys, this is important. This is really important. So what I want you to understand is, let's just say hypothetically you got $50,000 in your 401k plan, and you're 59 years old or older. Do you realize that you could take that entire 50,000, move it out the way, put it over here in a fixed account that is guaranteed growth without a single dollar loss, okay? But still have your employer contribute to your plan. All you did was safely move that money out the way so we don't have to stress or worry if tariffs are going to cause the market to crash. We don't have to worry about if the stock market is going to crumble. We don't have to worry. Look, I don't even worry. When the money is put over here, I know it's guaranteed not to lose a single penny. And you can do this exact same thing as long as you're separated from that employer. So I don't care what your age is. as long as you're separated from that employer. And I can tell you, I guarantee y'all put a 1 in the chat box right now, whether you're watching live or doing it right here with me in the seminar. How many of you have changed jobs and you forgot all about the 401k plan? You were so darn excited to get out of there. You're like, man, I got a new job. I am out of here. So you left that old 401k plan sitting. Well, you know what? That thing is being hit with market volatility and loss. You're not adding money to it. Your employer's not adding money to it because, heck, you don't work there anymore. And guess what? It's also being hit with fees, service charges, because whatever financial institution has that money, they're getting their money every single quarter, every single year. Whether you're making money or not, it doesn't matter. They're going to get theirs, okay? This is a way to safely move that money and get some growth on your money without any kind of risk. So, Paul, I think that was fantastic. My God, I tell you what, I think everybody, if right now, no matter where you're watching, just understand you can schedule a free consultation with us. It's not going to cost you anything but your time. What in the world do you have to lose? You have everything to gain, absolutely nothing to lose. Make sure you stick around to the very end of this. We are coming to the best. Let me tell you, I leave the best for last, babies. Make sure you stick around because I'm going to show you exactly how you're going to contact me. Now, if you're joining me through the seminar, you will receive a text and an email. If you're viewing me right now live, then you're going to have to go to the bottom right now on the live of the screen. There is a blue check box, a little blue notebook, or a yellow arrow. You can schedule your appointment right now during the middle of this live. All right. Y'all know I get excited about saving money now. You know I do. I am going to tell you the next gentleman, Mike, that's getting ready to join us. He hits hard for all of us because I know everybody knows someone that has needed care. Your mother, your father, your grandparents, your great-grandparents. And I don't think it's talked about enough. So we're going to bring Mike on. Mike's been in the industry 25 years, and he's going to talk about a little of those hard conversations that I know a lot of you have had with your loved ones. So, Mike, I'm going to let you have it, buddy.
Hey, Angie, thank you very much. And Paul, I appreciate all the information. My mother was a teacher. I like to follow in her footsteps. So I always appreciate being able to help educate people because the conversation around planning for care has changed pretty significantly. You know, here we are focusing on investments and talking about how do we grow our money and what risks do we have to think about. Unfortunately, for a lot of people, the risks and the costs associated with care can be incredibly impactful. And the conversation around how we plan has changed pretty significantly, especially over the last few years. Now, I've seen this firsthand several times in my own family, but most recently with a grandmother that had dementia for a decade. So I've seen firsthand how important it is to have a planning conversation. But that to me is the operative word here is planning. Because everybody I talk to is different. People have different concerns, people have different resources. So I only work through independent advisors and agents. So I think that's why it's so important, Angie. You know, you talk about people scheduling some time with you. You know, the fact that you're independent and you can do whatever is in someone's best interest to me is very important. I find sometimes people have these different pieces and parts and things that they've done. And, you know, maybe they've saved some at this employer and done some things over here. And, you know, it doesn't always make a cohesive plan. So to work with someone independent like yourself, you know, I feel like a lot of our job is just putting all these different pieces to the puzzle together.
Yes.
And just like you've touched on, number one goal is accumulation. Right, that is goal number one. We've got to make sure those retirement assets are where they need to be to provide that retirement income. Right, that's always goal number one. But of course, anytime we're doing financial planning, we've got to project out, okay, over the next 20, 30 years, what are some of the biggest threats to that secure retirement? And Paul, like you touched on, market volatility plays a huge factor. I mean, we've just seen how much volatility can all of a sudden increase at a short notice. So when someone's getting closer to retirement, that conversation around, okay, how do I protect this stuff now can be very important. And so anytime we're projecting out, what are some of the biggest impacts to our financial plan? Unfortunately, for a lot of people, it does tend to be those expenses associated with care in the future.
Yep.
Now, we've got all the baby boomers retiring at the same time. We've got about 11,000 people a day turning 70. People turning 70, they don't need care right away. They're going to run around and enjoy retirement. But we're already seeing more people need care than ever before. People are living longer than ever before, but we're not necessarily living healthier in retirement. And think of 40 years ago. Things like breast cancer, prostate cancer, those were major issues. Fast forward to today, both of those things are a pretty simple outpatient surgery. You can be home the same day. So we're living through all different forms of cancer, heart disease. We're getting things like Alzheimer's and dementia at greater rates. Medical science has been able to fix our bodies. They haven't been able to fix our minds. And just like I saw with my grandmother, I do find it's the cognitive issues that can be very impactful from a financial planning standpoint.
Yeah.
So when we talk about planning for care, I don't even like to use the words long-term care. What do you think of when you hear those words? Please feel free to enter it in the chat. If you've had anybody in your family or any friends that you've known that has been affected by these care expenses, please feel free to enter a 1 in the chat or to just say hello and maybe put in a little question or how you've been affected. But I do find that these expenses can be very impactful. I know my grandmother, when she needed care, it was over $120,000 a year. So we talk about market volatility. Well, certainly those care expenses can be very impactful. But you may never need care. This isn't about insurance. This is really about financial planning. So the conversation for care, I like to focus on really 3 key areas. First, let's focus on preserving the ability to choose. You may never need care, but I find most people, if they get to that point, they want to have choices. Well, that's why we need to plan to protect as many choices as possible, because we don't know what the future is going to hold. The second area of focus is really taxes. Paul mentioned it, Angie mentioned it. We have to be considering what taxes could we face in the future. A lot of people think taxes might go up. Well, let's make sure we find the most tax efficient use of our resources. And then the third area where this conversation has really changed the most, it's not just about the money. Obviously, the cost of care is expensive. It can be very impactful. But usually the bigger question is, if I actually need this stuff, what's going to happen? Like, what's going to be my experience? And of course, when someone needs care, it's an ongoing experience for them and really for everyone in the family. So the way the care is done, sometimes making sure that we can have someone come to the house. I find most people, they're more comfortable at home. We usually have a higher quality of life. It's a much better story if we can preserve those choices. So there's a number of ways to plan for this. I'm actually going to switch my camera real quick and talk through this at sort of a high level from a financial planning standpoint. Hello again. So when we talk about planning for care expenses, I like to think of expenses because ultimately that's all this stuff is, right? You may never need care, but if you do, ultimately all it is another expense. It's an expense that may or may not be there, but it is something that we can plan for. Now, by default, everyone does have a plan. People already have a plan, whether you realize it or not. Of course, by default, that is no plan. If you choose not to decide, you still have made a choice. Now, some people will call that self-funding. Now, you may have heard that term, self-funding. That is very simple. All that means is, hey, this is never going to happen to me, but if it does, I'll just pay dollar for dollar out of pocket. I've got plenty of money. I'll just pay for it. Well, this used to work okay 40 years ago because we didn't need care anywhere near as much or anywhere near as long. But now this can become a problem if we don't plan. So I don't hear this as much anymore. If I do hear this, it's usually one of a couple things. If I do hear this, sometimes it's someone who says, Mike, I've never had this conversation with my advisor. Well, that's where Angie and Paul come in because they run a plan. They look at all the different pieces to understand how these things can impact you. So that's important, and awareness continues to increase. The second time I'll hear this is if someone says, Mike, I've got a crystal ball. everybody in my family drops dead at 70. I know I'm going to drop dead at 70. I'm never going to need this. But remember, those health issues that affected previous generations are not having quite the same effect on us. We're living longer than ever before in retirement. So that crystal ball doesn't work. The last time I hear this is if someone says, Mike, the government's going to take care of me. Everybody's got a different opinion on the government. We're not going to get into that stuff today. But most people don't want to have to rely on a government program. We've got Medicare and Medicaid, but with both of those programs, they're not designed to pay for care. They only help us if we're destitute and we lose ability to choose. So we don't want to have to rely on a government program. They're not really going to help us with this. But by default, we're all self-funded. So what does that mean? Well, I like to look at someone's overall financial plan. Most people, when I look at their financial plan, they've usually got their assets carved up into different buckets. And usually those buckets have specific things they're supposed to do during retirement. Most people, assets are invested, whether it's in the market or real estate and various insurance or annuity products. That's always goal number one, right? We've got to grow our money as much as possible. Goal number one, let's make sure everything grows so we can have that retirement income where it needs to be. So that's always goal number one. Now, some people I've talked to, a bulk of their assets are in an old 401k or IRA. It's retirement money, but it's what we call qualified money. So 401k, 403b, whatever it is, it's money that is pre-taxed, but eventually we have to pay the taxes no matter what. In fact, there's been recent legislation that's changed the way that money is taxed. We have the ability to use qualified money to help provide tax-free long-term care. Now, I do talk to some people that, like Paul mentioned, they're concerned with protection and income. And so sometimes we'll use an annuity because an annuity offers tax deferral, guarantees, and it can give us a guaranteed income stream. It can work like a personal pension. So an income stream like that, protected with an annuity, can be a very valuable tool. But sometimes the big concern is needing care. And we do have a special annuity that can be tax-free to pay for those care expenses.
I just want to ask a question here. So I can take my qualified money, my 401k plan, and I can consider putting that into something like this. And instead of me having to pay taxes on that money, it's going to go into this plan that would take care of my long-term care. Is that correct?
Yes, that's absolutely. And so actually that's the policy that I own personally using an inherited IRA. Now we do have to account for the taxes at some point in the conversation.
Okay.
But these policies and this type of planning always provides tax-free
Now, Mike,
benefits.
what happens if I don't need care?
Well, see, now that depends on the type of planning that we do, because there are some plans that are called traditional or health-based long-term care plans. Now, these are the original plans that came out, and there's still some available, but unfortunately, they're use it or lose it, and they're not guaranteed, so premiums can go up. So some type of planning, if we don't need care, well, unfortunately, the money is just sort of a waste.
Okay.
But there are plans that do guarantee that if we don't need care, the money can go tax-free to our heirs. So it can go to children or charity or trust. But that's important. I'm glad you brought that up, because I talk to people every day who say, I don't know if I'm going to need care or not.
That's me.
I don't like to waste money.
Yeah, that's me. I don't want to waste money, but I want the money there if I need care. I don't want my children trying to figure out how they're going to pay for my nursing home, or my children trying to figure out how they're going to pay for my in-home care. I want to plan ahead, basically plan for the worst, hope for the best, and see what turns out.
Right. And so that's why this helps us preserve those choices. It's going to help give us tax advantages because we can have a tax-free benefit. You know, just think if you don't plan and now all of a sudden, oh, I got to pay for care, and it's going to be $80,000, $90,000, $100,000 a year or more. My grandmother, it was over $120,000 a year. And so what happens if we have these expenses? Well, we're going to have to pull from one of these buckets, right? We're going to have to sell our investments, which means we have to pay taxes. If we have to pull out more of that 401k money, that's going to create taxes. So the whole idea here, just like any financial planning, we want to carve out a piece ahead of time. We want to figure out, okay, if these expenses happen, what bucket would we pull from first? What asset would we need to sell to generate the income to cover the expenses? So if we can reposition something ahead of time, well, the younger and healthier someone is, the longer we can make that money last, which has the effect of putting a shield around the rest of the assets. So this is about asset preservation, even protecting a legacy. And so with this type of planning, there's only three things that can happen. There's only three outcomes. Most people are going to live a long life. They live a long life. At some point, they get sick or frail, need some type of care. Most likely thing to happen. Now, some people just pass